Mr. Setty, thank you very much for speaking to CNBC-TV18. Let me just start with a broader picture on your numbers for the quarter. Profitability, sure, higher than what the street was factoring in, but it's because of other higher income. Your core income has remained more or less flat year on year, if not slightly lower. How is the macro environment shaping up with everything that's going on globally and in India? Do you expect this fiscal to be better than the previous?
First of all, let me thank you for giving this opportunity, Ritu. On the core income side, I think we need to look at with a slight different perspective. We had one-time gain interest on tax refund earlier, of course, which is not there. If you adjust that, yes, you're right. I think we maintain the NII at that level. But this is despite 30 to 40% of the book getting repriced immediately by 100 basis points, and also the large fixed deposit book what we have. So I believe that I think we have done fairly well on the NII front.
Okay.
And on the margin side, I think we still protected our margins, and I'm sure through the cycle, through the year, we will be able to maintain that 3% advisory. In terms of the uncertainties, I think the tariffs may not, more than the direct impact of the tariffs, I think the uncertainty surrounding the tariff narrative is something what is slightly a matter of concern. Obviously, that needs to be addressed. From a bank asset quality or credit growth perspective, it may not have larger impact, because one is the export basket of India is widespread, both geographically as well as from a point of view, what we are exporting. The 4 or 5 sectors which we are talking about, which have predominant exposure to the US, the bank exposure on them is limited.
Okay.
So that is not really going to impact either on the credit growth or in terms of the credit quality.
So in summary, will this fiscal year turn out to be better than the previous?
I'm sure that I think there seem to be closure to many of the uncertainties, the global political tensions. The tariffs is not unique to India, right? It's not localized to India. It's impacting many other countries. So almost all the countries are coming to the grips with the tariff, which gives an impression or confidence that many of the corporates which are looking at whether to take an investment decision and not to take, I think will come around and move on.
Well, so your loan growth, 11.6% right now, year-on-year growth that you've seen. The corporate book, though, sequentially it has slowed down. Over the previous year, it's in single digits, the growth. What gives you the confidence that you'll be able to get to double digits, sometime in this fiscal on the corporate book, especially when you're noticing this trend of corporates now going to the markets for fundraising, utilizing other sources? What gives you the confidence?
The confidence mainly coming from the fact that we have very robust pipeline. In fact, the pipeline has increased over the last year. Today we have almost 7.2 lakh crore visibility of the corporate book, both in terms of the sanctioned loans but not disbursed, and also the pipeline of proposals under discussion. That is one part. Number two, the dip what you see in Q1 is essentially because whenever the interest rate reduction is happening, a lot of corporates come for renegotiation on pricing. Sometimes it is not acceptable to us, so we let go of them. Some prepayments definitely happened. There are almost 12,000 crores worth corporate loans got prepaid because we were not able to match the pricing or not. We thought that probably the pricing is too low. The second point what you mentioned in terms of corporate accessing the market, that is also one of the reasons why working capital utilization particularly has come down, because they have accessed the CP market, and CP rates are very low when compared to the bank loans. But bank MCLR loans are getting repriced, right? MCLR will get readjusted. I believe that some of this movement which has happened to the market will come back to banks. So the combination of better utilization of working capital limits and better drawal from sanctioned loans, we estimate that we should be able to come back to double-digit growth in the corporate credit.
And overall loan growth guidance for the year?
We are still sticking to 12% credit growth.
So which is not much of an upside from 11.6%, the rate that we're seeing currently.
Yeah, but we want to be, a little more balanced in that. In fact, I did say last time that if things improve, we may even reach 13%.
Okay.
But if you see this 11.6% growth rate, what we achieved is better than what industry has done.
Of course, that's 9.5% kind of rates. On the deposit as well, your guidance was about 10%. Is that something you maintain?
Yes.
And you believe the deposit repricing is done, so therefore margins which have shrunk in the quarter, what sort of headroom do you see, for further improvement, especially if RBI, maybe brings down rates further sometime in the future?
So the margin improvement is coming mainly the repricing of fixed deposit, which is likely to happen. In our books, normally it takes about 8 to 12 months for the 80% of the fixed deposit to get repriced. So that advantage anyway will come in. Number two is that the margin improvement on account of CRR cut. We almost will have 52,000 crores CRR.
Starting September.
That means, earlier also I mentioned that the NIM trajectory of U-shape will still, we are holding on to it.
Yeah.
It's a combination of the cost of deposits coming down and the repricing of retail loans becoming stable. At least till December, we don't see any further rate cuts. Which means that the retail personal loans, retail home loans will remain at the rate what it is today.
But it's a U-shaped recovery. It's not a,
it will be a U-shaped because there's a lag in terms of deposit.
So you'll be able to get back to or defend rather 3%.
So our exit NIM probably would be above 3.
A quick word on the asset quality as well. So typically we understand the first quarter does see a spike, but it's a biggish jump for you, from 4,200 odd crores to almost now you have 7,900 crores. Briefly for our viewers, where did this stress come from and other pockets of stress that lenders have been highlighting, whether that is MSME, MFI, is there something you'd like to point out as well? No,
first of all, I think the comparison should never be with Q4.
Yeah.
You should compare with the Q1 of the previous year.
Which is more or less flat. There's little bit of a
200-300 crores and in a book of 42 lakh crores is not a matter of concern. And also in the Q1 generally is the gross slippages, right? As we go forward to become net slippages. For instance, from the 30th June till today, almost 14 to 1,500 crores have been pulled back in the slippages. So there's no great concern in terms of the asset quality. We have not seen any of the segments doing, in our book at least, that any stresses.
On MSME, on MFI, some of
we
these
don't
pockets.
have much of an MFI book, and our exposure to the MFIs also is very limited.
I see.
So it's about 10,000 crores. So I have not seen any much stress there.
So asset quality now that we've covered, for the full year, if you could give us a guidance to close with where your credit cost could end up and what your full year slippage and recovery could look like.
So on the credit costs, we had given a guidance of 50 basis points earlier. I think we're still sticking to that. And in terms of the gross NPA, 2% is something what we have indicated, and we're still sticking to that.
All right, sir, and we wish you the best with those targets. Thank you very much for your time here today.
Thank you, Ritu. Thank you.